Warren Buffett finished the Lehman annual report.
Right.
I think that's hundreds of pages
Right.
in one day.
Right.
And he somehow picked up a 100 million potential loss from
Right.
Japan.
Right.
How do you think he did it?
I have no idea. I never read the Lehman report. I have no idea how he did it.
That's like picking needles out of a haystack. And also, he had a conversation with the CEO.
Right.
And the problem is, CEO did not discuss this.
Well, that was probably the trigger. It's like I assume that Warren.
That was the decision trigger.
Right. Warren can very quickly size up someone, and I'm just guessing that he's a very good judge of character, and that he could tell someone doesn't know what's going on. And when you're leveraged 30 to 1, which Lehman was, you're only allowed a 1% loss before you go 50 to 1, because you have 2% assets, 100%. I mean 2% equity and 100% assets, and that's when the regulators start coming in. And so it wasn't, if you have a lot of volatility in your assets in terms of what an asset-backed security is worth, which the mark-to-market was going everywhere. Well, it wasn't going everywhere; it was going straight down back then. Then it was pretty quick to know that they were going to need capital pretty quickly. I mean, of course, it's all 2020 with hindsight. So.
Do you look into insurance companies?
I have owned insurance companies before, and again, it's somewhat of a black box. You just basically have to say, well, what type of insurance company first? What type of?
What's your insurance?
Tower Group.
Who?
Tower Group.
What do they do?
Property, personal life.
So they have life insurance and they have
property casualty.
Okay. I know how to do property casualty. I'm not sure how to do life, but property casualty, you look at what type of tail they have,
Okay.
and you compare the day sales receivable to its historical pattern. And if it's down a lot, then you have something to worry about. If it goes from what's an average life of the between the time there's an occurrence until the time it's paid, like.
That's the problem. It's not a business I'm too familiar with. I just like the numbers.
Okay, so if there's in insurance, there's something called short tail and long tail for PC. So short tail is something like car insurance is very short tail. You know when you have an accident, you pay it out within 3 months or a year or something like that. Whereas workers' comp is very long tail, or environmental asbestos is very long tail. I mean, you file, you sign up. You're like a insurance company. You sign some contract that earns you $10,000 in 1955, and you have to pay out $1 billion in 1995. It's just extremely long tail, and they're both property and casualty companies. So you want to figure out how long your tail is, and then comp it. Like if you're an auto insurance company, you want to comp it against Progressive or Allstate or State Farm. Even State Farm is a mutual, but you can go onto their site and they'll give you their annual report, or you can call up the insurance commissioner at the state level and get their yellow book, which is statutory. And you want to comp it against it itself historically, and you want to comp it against its peers. And if it's out of line with its peers or historically, if the receivables days reserved go down, there's usually something fishy going on. Right? Or if it's down 100 days compared to everyone else, there's something somewhere. The opposite is true too. If it's reserved 100 days more than everyone else, maybe the book value is understated. Maybe they're super conservative. Also, you want to look at the premiums to equity to statutory capital. If the ratio is lower than its peers, then they're being more conservative. They have much more capacity. If it's higher than its peers, then they're running closer to the edge. So, but that's PC. I don't know much about life. The last time I invested in a life company 10 years ago was MetLife when I came out of the demutualization, and I just, again, it was, you could read the footnotes, but it was coming out of a crisis. This was like 2000 or something like that, or 99. They were trading at like 60 or 70% book. They were well capitalized at the time. They had all these money management organizations. So you value life insurance companies on a book value, which is kind of strange because it's all an estimate. You don't know what the liabilities are and you don't know what the assets are, but it's ironic that they do it on the book value. I guess it's the best way. But they had New England Asset Management, which owned Harris. They had all these things. They owned Stuyvesant Town. It wasn't really reflected on the books as a market value then. So there were all these hidden gems. And that was the last time. I think I invested in Manulife, these Canadian demutualizations, but I haven't done a life insurance company in a long time. But it's basically, you just have to, if I were to do one, I'd look at the equity to assets, tangible equity to assets, and that's where I'd start. So.
What other sectors you don't invest? You don't invest in insurance?
Well, everything has a price, right? I mean, generally, you do better. There's some businesses that produce more cash than others, like software companies generally produce more cash. Service companies generally produce more cash. So that's generally, it's easier to be attracted to that. I'll give you an example. What's the difference between Intel and Microsoft?
Intel is
power. Intel's cash.
Which one? Okay, all things being equal. Okay, over a 10-year time frame, which one would you rather own? And that's not fair because right now Microsoft probably has more risk given what's going on in Google. But let's take the Google equation out. Let's make the huge assumption that the Windows and the Microsoft Office franchise will be intact 10 years from now, which is a huge assumption. Okay, let's just make that assumption. Which one would you rather own for the next 10 years, Intel or Microsoft?
It depends on the price.
Assume both of them are trading at 12 PE. So they're same valuation.
By Microsoft.
Why?
Because Microsoft doesn't have the capital investment requirement.
That's right. Both of them get about the same amount. They both go in a computer. They both get like $50 or $100, depending on what chip you get, depending on what kind of office suite you get. But they both get about the same ASP per box. Okay. But Microsoft's profits all end up in cash, whereas Intel's profits, half of it end up in cash, and half of it end up as a fab in China. And that's why, over a long period of time, you'd rather own the cash generative business because it's going to be there. The cash is there. You don't have to liquidate it. It's there. So, but there's a price for everything. I mean, I'll buy S&Ls are not a good business. The return on capital is 4 or 5%, which is value destructive actually. And the only way you make money though is if you buy it at 60% of book or lower, and you assume that they don't make any bad loans and that there are not that many write-offs in the future. For example, it gets a little risky here, but if you were to ever buy GM, okay, and generally I would stay away from GM because of the union costs and stuff like that, because all the money. I always find it really funny that when GM has layoffs and stuff like that, and they announce layoffs, they always focus on the poor worker. Well, the assembly line workers were the only ones who made out to be winners in this whole thing. All the debt holders of GM, all the equity holders lost. It was the pension fund and the retiree benefits and those workers that were saved or made more whole than the security holders. So I always find that funny. But if you were to ever buy GM, it might be interesting when the government sells. And there's two reasons for that. Usually when the government sells any asset, they always underprice it. Generally, whenever the government sells anything, they always underprice it. If they ever sell insurance, flood insurance is always underpriced, right? They sell the same, basically a very close, like same premium if you live in Iowa as if you live on Long Beach. It's basically the same premium. They totally underprice it. Okay, they obviously underpriced the Freddie Mac insurance, the homeowners insurance. So if they start selling health insurance, you know they're going to underprice it because the taxpayers pay, right? And in general, if they sell something like GM, they're more concerned about just not having it on their books. They're not an economic seller. They're a political seller. They're a bureaucratic seller, and they don't have the economic interest of their client, which is the taxpayer, at heart. It's nice if they make money. It makes a good political headline, but they're not going to take home that GS15. It makes $150,000 a year. He's not going to take home, a $500,000 bonus because he sold GM at a point higher than he would have, right? So if you were to ever, if the government sold GM tomorrow, it'd be tempting to look at for three reasons. One, the government's selling it. That's the first flag. Disinterested selling. They cleaned up the balance sheet during the bankruptcy, so it gives you some room. Okay. And number three, you're buying it when they're only making 12 million cars, right? Preferably you buy it when they make 9 million cars, because